Hello, this is Mr. Smith, and this is the second lecture for Honors Economics Unit number 4. And we'll talk about monetary policy and banking regulation. We'll go over the Federal Reserve banking system and central banks in general. We'll talk about bank regulations, what kind of rules and supervision exist for banks, how a central bank executes monetary policy. Monetary policy involves the supply of money. Fiscal policy involves the spending of the government, particularly the legislative branch. Those are two different things. Monetary policy and economic outcomes. So how does the supply of money alter how the economy is performing? And some of the downfalls of monetary policies. We'll go over all of those today. And some of the most influential decisions regarding monetary policy in the United States are made behind these doors of the Federal Reserve. And because of that power, it sometimes gets some criticism because of its lack of transparency, but also because there are people that just don't understand economics and they believe that this is some kind of secretive cult that is controlled by the elite, and there's all kinds of crazy conspiracy theories that go on about it. But actually, the Federal Reserve is a hybrid system that is established by government acts. The leadership is appointed by the president and approved by the Senate. The leadership reports to Congress through its oversight function. And the Federal Reserve itself is made up of nationally chartered commercial banks, so for-profit banks. And some people might say then, well, it might be mostly private sector since it's operated through the national banks that are privately owned by stockholders and so on. But that just means they're looking out for banks. And the thing is about that, yes, they are, but why would banks want the economy to collapse? Why would they want it to do terribly? They obviously want it to do well. And so the Federal Reserve definitely has a vested interest in making sure that the economy is performing properly. A central bank like the Federal Reserve is responsible for conducting monetary policy and ensuring the nation's financial system operates smoothly. In the U.S., the central bank is the Federal Reserve, known as the Fed, and that's what we'll call it for the most part throughout this lecture. It's semi-decentralized, mixing government appointments, as I just mentioned, with private sector banks. It's run by a board of governors consisting of 7 members and appointed by the President of the United States and confirmed by the Senate. At the time that this PowerPoint was put together and the textbook was last updated, Janet Yellen was the Federal Reserve chairperson. She was the first woman to hold that. She has been nominated to be Joe Biden's Secretary of the Treasury. Well, the chair of the Federal Reserve has only one vote. They control the agenda and is typically the face and voice of the Federal Reserve. It's currently Jerome Powell. The Federal Reserve is broken up into these 12 districts, and you can see Western Pennsylvania is part of the branch out of Cleveland, of all places. And then the other sections you can see are broken up based upon earlier population and financial activity. The truth is that probably this area of California on the coast could have their own. It doesn't, but there's not as much nearly activity as goes on in the rest of this area. But the Federal Reserve is more than a board of governors. It includes these 12 regional Federal Reserve banks, each of which is responsible for supporting the commercial banks and economy in general in each of these districts. It is designed to control the money supply and enact policy through it, known as monetary policy. It needs to promote stability in the financial system. A roller coaster ride, big ups and downs, those are undesirable. And it needs to provide banking services to commercial banks and other depository institutions. So it provides loans, for instance. It provides places to store money and other assets. So it provides banking services also to the federal government. Banking regulation is intended to maintain bank solvency by avoiding excessive risks. The problem is, of course, is that when you have lots of money, it is easy to make money on top of having money. The problem is you can get into some risky investments that you can end up losing that money. And that wouldn't be as big of a deal if banks didn't have other people's money. The money that they have comes from depositors, which are people like you and me or businesses and so on. So that's why banks need to be regulated. regulation falls into a number of categories. Reserve requirements, requiring them to keep a certain percentage of their deposits on hand. Capital requirements. Capital requirements are standards that banks must follow that determine how much liquid capital, such as cash, for instance, they must keep on hand concerning their overall holdings. So it compares, for instance, from the last lecture, how much they have in liabilities and how much in assets, and there has a certain ratio they must have. There's a capital requirement based on the weighted risks of the bank's different assets. So in other words, they need to make sure they have a certain amount to cover the liabilities in representative to how many assets they have. So the reserve requirement is how much of those deposits they actually need to keep, a certain percentage across the board for everybody. The capital requirement is an additional standard that is based on the ratio between the liabilities and assets that they have. So, everybody has to have 10%, but then is this bank loaning out a lot of it, and is it not holding as much in reserve as another bank? Some banks are more conservative, and so even though they have this reserve requirement, maybe they're keeping more cash on hand. Maybe some banks are loaning it out in very safe ways, and so they don't have to keep as much on hand under the capital requirement. And so there can be different reasons why this other standard exists. And there are restrictions on the types of investments banks may make, because they're not allowed to just play with people's money and put it wherever they want. Banks can make loans to businesses and individuals and to other banks. They can purchase U.S. Treasury securities or bonds, but they are not permitted to invest in the stock market or other assets that are deemed too risky, because once again, they would be risking other people's money. And there are a number of other government agencies that are involved with supervising the banking industry. The Office of Comptroller of the Currency has a staff of examiners who conduct on-site reviews of the national banks. The National Credit Union Administrator supervises that particular type of financial institution. And then there's the Federal Reserve itself, which does have some responsibilities involving the supervision of financial institutions. Firms that own banks and other types of businesses, since they own different types of institutions, are called conglomerates. But since they own banks in particular, they're often referred to as bank holding companies. Those are also watched over as well. And one of the reasons why we want banks to be safe is because something that used to happen quite often, bank runs. Bank runs were when depositors would race to the bank to withdraw their deposits out. And these happened a lot during the Great Depression, but also in other economic panics like 1907, for instance. And here's what could happen. Someone could be walking down the street and, a common phrase is, I don't know if it is anymore, but it used to be, you can take that to the bank. So it's safe, it's secure, it's something you can count on. But let's say someone's walking on the street and they said to their friend, you can take that to the bank. Well, someone on the opposite side of the street walking down the sidewalk might have heard the word bank and thought they said the bank's in danger, the bank's going to close. And so they rush to the bank to pull their money out. And on the way, they tell 2 or 3 other friends, and then they go and they call their neighbors. And so then you end up with a mass amount of people at the bank pulling out their money. And if they only keep 10%, then they're only going to be able to cover 10% of the withdrawals. And if you're not one of the first people there, then you are out of money. Before the Federal Deposit Insurance Corporation existed, banks did not have necessarily insurance to cover people that were at the end of the line that didn't get their withdrawals out on time. And so often banks would have to fold, and people just lost their money if they had it saved there. So because of this situation, it was decided that there needed to be a centralized bank and that it had to supervise the smaller banks and establish requirements for them. And we also developed the institution I just mentioned, the FDIC, that is responsible for deposit insurance. Banks pay an insurance premium a monthly or yearly fee, just like you do for car insurance or health insurance, to the FDIC. The insurance premium is based on the bank's level of deposits. So the more money they have in deposits, the more liabilities they have, then the greater the premium is going to be. Then it's adjusted according to the riskiness of the bank's financial situation. For example, right around the time of the last recession, a fairly safe bank with a high net worth might have paid 10 to 20 cents in insurance premiums for every $100 in bank deposits, while a risky bank with very low net worth might have to pay 50 to 60 cents for every $100. So the riskier and less money you have, the more the premium is altogether. And since this insurance exists, bank runs don't happen anymore. People don't worry, oh no, our bank is going to close. Certainly, if they read that the bank's having problems, they're going to call them or visit, but it's unlikely you're going to have a rush of people going to the bank to pull out their money. And another reason why bank runs don't happen anymore is because the Federal Reserve is the lender of last resort. And so there's actually a system. The Federal Reserve, which is made up of the nationally chartered commercial banks, will loan out money to other national banks, will loan out money to regional banks, will loan out money to medium-sized state banks, only existing within a certain state, and they'll loan out money to local banks. So because of this lending system, it also means that there's less of a chance of default happening. The Federal Reserve's most important function is to conduct the nation's monetary policy. And this is used mostly through interest rate and credit conditions, so borrowing and buying and selling of bonds in particular. The most common monetary policy in the U.S. are called open market operations, and they're controlled by probably the Federal Reserve's most important institution, which would be the Federal Open Market Committee, or FOMC. It's comprised of 7 members of the Federal Reserve Board of Governors and 5 voting members from the regional Federal Reserve banks. Typically, the open market operations involve the buying and selling of securities or bonds to control the money supply. So open market operations involve buying and selling of bonds. To increase the money supply, the Fed will purchase bonds from banks. And so since they're buying these bonds back from the banks, they're giving the banks cash, which injects money into the banking system. It will sell bonds to reduce the money supply. It will say to banks, here, buy these bonds from us. We're taking the cash off you for them. And that decreases the amount of money supply in the system. So here we see a ledger for Happy Bank. And it starts with $460 million in assets. We can see right here, 300 plus 120 is 420 plus 40 is $460 million in assets. Divided among reserves, bonds, and loans. So there's 3 types, reserves, bonds, and loans, and $400 million in liabilities in the form of deposits. So that means the difference between 460 and 400 is 60 for their net worth. B shows when a central bank buys bonds. So the Federal Reserve has purchased bonds from them. And remember, whenever it purchases bonds from banks, it injects money into the system. It's buying money, or it's buying bonds from this bank. It's giving them cash, and so it has more cash on hand. It shows when the central bank purchases 20 million bonds from Happy Bank, the bond holdings of Happy Bank falls from 120 by 20 to 100. So now it has $100 million in bonds. However, if you note up here, it now has $20 million extra in reserves for a total of $60 million. Before I go on here, just looking at C, says you can tell the bank can make additional loans now because they have the extra money. So they had 60, but they're going to loan out an additional 20. So now they have loans outstanding of $320 million. So they put this $20 million out into the economy. Then we can see the opposite is being done. So we go back to the same original up here at the top, 41, 20, 300, 40 and 60 over here on the side. And this time, though, Happy Bank is going to purchase 30 million in bonds. The Federal Reserve, the central bank, is selling bonds. So Happy Bank purchases them, and so now it has 30 million in bonds, so it's up to 150. But they've also taken $30 million out of reserves, and they're down to 10. In order to have enough in reserves, because they need to bump that back up to 40, they're going to remove $30 million they have outstanding in loans, or they're not going to make future ones, and so there's going to be $30 million less. And so that's going to bring their total amount outstanding to $270 million in loan assets. That means, of course, is people in the community are getting $30 million less in loans. So many houses not bought, so many cars not bought, so many businesses not expanded. You might wonder why in the world would they do this? They do this when there's inflation, when prices are going up too much because the velocity of money and the supply of money is too great. And so it needs to be reduced. So C shows the Happy Bank wants to hold 40 million reserves once again. So they decide to reduce the amount of loans. The second method of conducting monetary policy is for the central bank to raise or lower the reserve requirement, which is the percentage that each bank's depositors think that is legally required to hold either as cash in their vault or in deposit with the central bank. So they can put them in either place. They don't have to have them in their vault necessarily. A greater reserve requirement, so if it was 20% instead of 10, it means you have less money available to lend out. A smaller reserve requirement, if you drop it to 5%, means there's a greater amount of money to lend out. So this is another method they can use to either expand or contract the economy. They can expand the economy by lowering the reserve requirement. They can contract the economy in the case of high inflation by requiring a greater reserve amount. In practice, the Fed rarely uses large changes in reserve requirements to execute monetary policy, because obviously that can be a sudden shock to the banking system. The third traditional method for conducting monetary policy is to raise or lower the discount rate. And this is the interest rate charged by the central bank on loans it gives to other commercial banks. And so it doesn't necessarily force all interest rates to go down the same amount, but it obviously does have a trickling down effect on the other interest rates the other institutions charge. So if the central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans to replace some of those reserves. Since there are fewer loans available, the money supply falls. And so higher interest rates are going to remove money from the system. If the central bank lowers the interest rates, then obviously the opposite is going to happen. That would be an expansionary monetary policy. Expansionary or loose monetary policy increases the money supply. And once again, you do that by lowering the reserve requirement, lowering the discount rate, or purchasing bonds from banks. You're purchasing the bonds, giving them cash, all that will expand the economy. To contract or tighten the monetary policy or the money supply, you would do the opposite of those things. You would raise the reserve requirement, raise the discount rate, or you could also sell bonds, because if you're selling bonds to the bank, you're taking the cash off of them. The federal funds rate is the interest rate at which one bank lends funds to another bank overnight. So we talked a little bit ago about how the banking system acts as a loan to last reserve, and there's a web of loaning that can happen. And so how does the central bank raise interest rates? Through the open market operations, the central bank changes bank reserves in a way which affects the supply curve of loanable funds. The Federal Reserve has since 1995 established its target federal funds rate in advance of any open market operations. So this one, the interest rate of loaning between banks, is often altered before the open market operations. In fact, since 1995, it just has been. If open market operations do not meet the Fed's target, the Fed can supply more or less reserves until interest rates do. So here we can see the money supply. Here it is, the original one, S0. And we can see the quantity of money in billions of dollars and the price of money, which is reflected with interest rates. And when we expand the monetary policy, when we flood more money into the economy by lowering the reserve requirement, lowering the discount rate, or purchasing bonds, putting cash into the bank's hands, then we see the supply curve move outward, and we're going to see interest rates fall. And lower interest rates means more loaning and purchasing is going to happen. The opposite is true where we raise interest rates. And we can do that by, for instance, if we change the money supply, we can do that by raising the discount rate, raising the reserve requirement, or selling bonds by taking money out of people's hands. If the money supply is decreased, then you can see interest rates will go up. An expansionary monetary policy will shift supply of loanable funds to the right, reducing the interest rate from 8 to 6% in this particular case, and contractionary policy will shift it to the left and raise it from 8 to 10. Monetary policy affects interest rates and the available quantity of loanable funds, which in turn affects several components of aggregate or total demand. Tight or contractionary monetary policy will reduce two components. Business investment. Obviously, if there's less money, less business investment, purchasing capital of storefronts and factories of tools, that will go down. Consumers borrowing for big ticket items, buying cars, buying houses, buying furniture packages, those things are going to happen less. A loose or expansionary monetary policy will do the opposite. It will increase those two things. In A, the economy is originally in a recession with the equilibrium output shown at E0. So this is the aggregate demand. This is short-run aggregate supply. This is the output, the productivity of the economy in constant dollars. And this is the price level based on a year. And so this is using a price index. In A, the economy is originally in a recession. Expansionary monetary policy reduce interest rates and shift aggregate demand to the right from AD0 to AD1. And so you can see in this first example, it's shifting it. Sorry if I was pointing over here. It's this one, AD0 to AD1. And so demand has increased, and so therefore output should also increase from 600 to 700. So we should become more productive because people are purchasing more. But it will lead to an increase in price level, but it is modest. In B, the economy is originally producing above the potential GP level output at equilibrium E0. This could lead, of course, to inflation. So contractionary monetary policy will be induced, and you can see aggregate demand will shift to the left. This leads to a new equilibrium at the potential GDP level output, so it does fall, and we do have a decrease in price levels, so that inflation will have been avoided. Monetary policy should be counter-cyclical or cyclical, moving in the opposite direction of the business cycle of economic downturns and upswings. For A, in expansionary monetary policy, the central bank causes the supply of money and loanable funds to increase, which lowers the interest rate, stimulating additional borrowing for investment and consumption, and shifting aggregate demand to the right. Whereas contractionary policy will do the opposite thing. It will cause, of course, the money supply to decrease. It will cause an increase in interest rates. It will discourage investing. It will discourage consumption, and it will cause a fall in price levels. Now, you have to be careful because it also will cause a fall in real GDP. And in the early 1980s, when they were trying to get double-digit inflation under control, that's exactly what did happen. It ended up lowering GDP enough that it caused a recession. But that might have been necessary because inflation was just too high. Through the episodes here, the Federal Reserve typically reacted to higher inflation with a contradictory monetary policy and higher interest rate, to higher unemployment with an expansionary policy. So when there's inflation, they use contraction. When there's unemployment, they use expansion. Quantitative easing. This is the purchase of long-term government and private mortgage-backed securities, bonds, by central banks to make credit available so as to stimulate aggregate demand. So the purchasing, once again, which is putting cash into the economy. Quantitative easing differs from monetary policy. It involves the Fed purchasing long-term treasury bonds rather than short-term bills. In 2008, when we had our last recession, though, it was impossible to stimulate the economy any further by lowering short-term rates because they were already as low as they could get. So then they moved on to long-term. This leads to a second way that quantitative easing is different from traditional monetary policy. Instead of purchasing treasury securities, the Fed also began purchasing private mortgage-backed securities, something it really hadn't done before. During the financial crisis, which precipitated the recession, mortgage-backed securities were termed toxic assets because the housing market collapsed. And we'll go more into this later, but banks were basically bundling mortgages, especially riskier ones, selling them to other financial institutions to get some of those, to basically earn more money. And that ended up spreading a lot of toxic, risky investments throughout the economy. So the Fed started experimenting with purchasing some of those back. That was, in fact, one of the problems that caused the recession to happen in the first place. Banks are legally required to hold a minimum level of reserves, but no rule prohibits them from holding additional excess reserves. Excess reserves are those that banks hold that exceed the legally mandated limit. And so those can be a concern too. If banks and people also are holding on to too much money, then their expansionary policies might not work out as well as they thought. The velocity of money is also something they need to keep track of. This is the speed in which money circulates through the economy. And you can calculate it by taking the nominal GDP and dividing it by the money supply. The nominal GDP is the gross domestic product, or value of total productivity in the economy at current prices. And of course, we can rewrite the definition of velocity so that the money supply is on the left-hand side of the equation. This is called the basic quantity equation of money. So money supply times velocity equals nominal GDP. So once again, nominal GDP is the price level times the real GDP, so current prices. And money supply times the velocity, therefore, equals the price level times real GDP. So looking at this equation, we see that changes in velocity can cause problems for monetary policy. Velocity is the nominal GDP, once again, divided by the money supply for a given year. We can calculate different measures of velocity by using different measures of the money supply. If we're just using M1, remember that's just taking into account things like currency and checks. And so this has the highest level of liquidity. It has lacked a steady trend since the 1980s, bouncing up and down. So the velocity, or the travel speed of currency and checks has changed quite a bit over time, you can see. Most central bankers believe that the primary task of monetary policy should be to fight inflation. The vision of focusing monetary policy on low-rate inflation is so attractive that many countries have rewritten their central banking laws since the 1990s to practice inflation targeting, keeping it low. And the United States has generally done that, and it's kept it low, below the creeping rate of 3% most of the time since the early 1980s, with a few exceptions. Economists have no final consensus on whether a central bank should be required to focus on only inflation or should have greater discretion over other types of economic issues. Should they be concerned about unemployment? Should they be concerned about the overall GDP? In a neoclassical view, monetary policy affects only the price level, not the level of output in the economy. So for a more conservative neoclassical economists, they would say no, they shouldn't be concerned about anything else. For example, an expansionary monetary policy causes aggregate demand to shift from the original, from ADO to AD1. However, the adjustment of the economy from the original equilibrium to the new equilibrium represents an inflationary increase in the price level from P0 to P1. So prices definitely have gone up. But over the long run, remember that the supply is going to happen no matter what. And so the long run supply is this perfect vertical line. So neoclassical economists just concentrate on this. That's why they typically say, oh, just wait until this recession is over, wait until this depression goes on another year, and eventually we'll get back to normal business because the long run supply curve is vertical. And so they would say that's why there's no point in the government getting involved, because it's just going to change price levels and not productivity over the long run. This is a little bit of a misnomer, though, because obviously, what about the short run? And how do we define the short run versus the long run? Is it a year? Is it 2 years? Is it 10 years? And over the short run supply, of course, as we know, let me go back to one of these previous charts. The supply curve is U-shaped. Oops, here we go. So there you can see that's a little bit different. So a Keynesian economist, for instance, who does believe that we should influence the overall economy from a macroeconomic point of view by the Federal Reserve or some other type of central bank, they believe that the short run curve can certainly be reflected in the models, and it should be used. And it helps prove mathematically that a change in aggregate demand by expanding the economy will also improve output.